looking at the most sophisticated institutional investors that are out there. And they have, sufficient capital to basically invest in any assets that they want in the world and construct whatever portfolio they want, right? They're totally unconstrained. And I think what you look at their portfolio, and basically what they've got is they've got about half of their portfolio in a diversified, liquid markets set of, assets. So things like stocks, bonds, commodities, depending on the place, gold, things like that. And they have about 50% of their assets in what sort of would be classically termed as alternatives. But I think the thing that and amongst those alternatives, they have typically about 20% of their overall portfolio in diversified alpha is probably the best way to describe it in one form or another, and about 30% of their portfolio in various equity and credit-like exposures like private equity, venture capital, private credit, et cetera. And so you think about that portfolio, you basically say, well, if the most sophisticated investors in the world are building that portfolio because that's the most efficient portfolio to preserve wealth over the long term, how do we help get investors to that portfolio? Because that's a great portfolio. That's what you want. And I think the key thing to keep in mind, in addition, is they're not just building that portfolio, but they're actually building that portfolio at a very low cost. And the reason why that is, it's both highly diversified and low cost, is that what they do for each one of those buckets, particularly, on the public side, they're basically investing they're internally often managing public exposures, just buying the stocks themselves, which is essentially, very, very low cost because they're basically internalizing it. And on the private side, on that alt side of the portfolio, what they're doing is they're investing in a bunch of managers and beating them down on fees. Like, to put it very bluntly, I look at some of these big sophisticated investors, and they're not paying 2 and 20, they're paying 50, 75 basis points and 10. Like, they are cutting the fee down hugely. And when you look at those strategies, right, and you cut the fees in half or they're a third of the fees, those are totally different types of opportunities than when you pay rack rate 2 and 20, or for most people worse than 2 and 20.